Imagine this. You've saved for years, your credit score is a solid 750, and you're ready to buy your dream home. But when you apply for a mortgage in 2026, the lender says no, not because of your score, but because of how you spend your money. That's the reality of the new credit score reform. And if you're planning to buy a house this year, you cannot afford to ignore this. Welcome back to Credit Unlocking. If you're watching this, you're probably thinking about buying a home in 2026. But here's the thing, the rules just changed dramatically. FICO, the company behind the most common credit scores, has doubled the price lenders pay for mortgage scores. And that's just the start. So what is the 2026 credit score reform? In simple terms, it's a massive shift in how lenders assess your risk. Instead of relying solely on your traditional three-digit score, the one based on payment history and debt levels, they're now incorporating behavioral data. Behavioral data means things like your spending patterns, subscription cancellations, even how often you check your credit. Lenders argue this gives a fuller picture, but for you, it means your morning coffee habit or that gym membership you forgot to cancel could now impact your mortgage approval. Now let's talk about the cost. FICO has doubled the price for mortgage credit scores. Previously, lenders paid around $5 per score pull. Now it's $10. Why does this matter to you? Because lenders might pull your score less often or be more selective, potentially delaying your application or making approvals tighter. Here's a real example. Meet Sarah. In 2025, with a credit score of 740, she qualified for a 3.5% mortgage rate on a $300,000 loan. Fast forward to 2026, with the same score but erratic spending on delivery apps, her rate jumps to 4.2%. That's an extra $120 per month, or over $40,000 in interest over the life of the loan. So what can you do? Step 1. Audit your spending. Go through your bank statements from the last 6 months. Look for patterns. Are you overspending on non-essentials? Lenders now see this as a risk, even if you pay your bills on time. Step 2. Stabilize your subscriptions. Cancel unused memberships and set up autopay for the ones you keep. This shows lenders you're in control of recurring expenses, which is a green flag in the new system. Step 3. Limit credit checks. In 2026, every hard inquiry matters more because of the higher cost to lenders. Space out your applications. Don't apply for a new credit card and a mortgage in the same month. Step 4. Boost your traditional score. Yes, behavioral data is new, but your FICO score still carries weight. Pay down debts, keep utilization below 30%, and never miss a payment. Aim for at least 750 to stay competitive. Step 5. Talk to lenders early. Don't wait until you're ready to buy. Reach out now, how they're implementing the reform, and get pre-approved under the new rules. This gives you time to adjust and avoid surprises. Let me hit you with one more shocking fact. Under the new system, someone with a score of 700 but consistent, frugal spending might get a better rate than someone with a 750 score who splurges randomly. It's no longer just about the number. It's about your financial behavior. So here's my question for you. Based on what you've learned, do you think your current spending habits would help or hurt your mortgage chances in 2026? Drop a comment below. I read every one. If this video helped you, smash that like button and subscribe for more 2026 credit tips. Share it with a friend who's buying a home. They'll thank you. And don't forget to check out our related videos on raising your credit score fast and finding the best mortgage lenders this year. Thanks for watching, and I'll see you in the next one.